Okay, so we're ready to start Chapter 5 homework. All right, and this first problem is exercise 9, which is on page 265 in your book. And let's look at the requirements. Let's see what they want us to do. The first one, record the adjusting entry for uncollectible accounts on December 31st. All right, and then they give you that nonsense about if no entry is required. Well, there will be an entry required. And what entry are you going to make on December 31st? Forget about the numbers for a minute. What accounts are you going to debit and credit on December 31st? Adjusting entry for uncollectible accounts. Anybody? Debit what account, credit what account? No? No takers? All right, because look at this as really being two questions you're being asked to answer here, right? One question is, what are the accounts that I'm going to debit and credit? And that's pretty easy because in this chapter, I mean, there are only like maybe, I don't know, 3 or 4 or so transactions that involve accounts receivable. So the entry that we're going to make, and what account are we only allowed to debit on December 31st as it relates to this, right? Debit bad debt expense, credit, allowance for uncollectible accounts. So if that's all you did, you got half credit. Right? And I don't think that's asking too much of you. Right? Now, the second part, the numbers. Okay, well, let's see. Southwest Pediatrics has the following balances at December 31st, 2021, before any adjustment. Before any adjustment. So the accounts receivable balance is 130. The allowance for uncollectible accounts has a debit balance of 2,100. And then on December 31st, 2021, Southwest estimates uncollectible accounts to be 20% of accounts receivable. All right, so let's see if we can make a little worksheet for this. Let's say we had a T account for accounts receivable, right? There's a T account for accounts receivable. And this is the debit side, right? And this is the credit side. Now, they told you, if you go back and read the problem, they told you the balance was $130,000 on December 31st, 2021. Okay. Now, this account has a cousin. let's call it allowance for uncollectibles, right? And what are they telling you about this account? It has on this, now again, we have a debit side and a credit side. But remember, this allowance account is contra, right? This allowance account is contra, which means that the balances in this account offset the balances in this account. Now, they told you that the balance was $2,100 before adjustment. $2,100 before adjustment. Right? $2,100 before adjustment. Then they told you that, how did they tell you? They told you that Southwest estimates uncollectible accounts to be 20% of accounts receivable. Well, accounts receivable is 130,000. And what's 20% of that? Is that 26,000? Right? That's 26,000. So that's their way of telling you they want this number to be 26,000 when you're finished. They want the balance of the allowance account to be 26,000 when you're finished, right? So now just apply what you already know about debits and credits, things that you learned a few chapters ago, right? If I have a debit balance of 2,100, but I want it to really be a credit balance of 26,000, what do I have to put in the account to do that? Sounds to me like 28,100, right? Because 28,100 credit minus 2,100 debit is 26,000, right? Now let's go back to the question and put that number in. 28,100, 28,100. Check my work. What happened? Oh, there it is. See? So it was right. Now let's go to the next part of the question. Determine the amount at which bad debt expense is reported on the income statement and the allowance for uncollectible accounts reported on the balance sheet. Well, the amount of uncollectible accounts reported on the balance sheet is that 26,000. The bad debt expense, if you just go back and look at the entry, the debit to bad debt expense was 28,100. Check my work. Take advantage of that. Okay. Now, again, you know, don't get confused when you see something like this, because this is them just asking you questions and you having to put a number in a box, right? But to understand what you're doing, you need to go back and look at the actual accounts, right? This is the number that goes on the balance sheet, this $28,000. And this 28,100 is what goes on the income statement. Okay. Let's go back to this. Calculate net accounts receivable. Net accounts receivable. Well, net accounts receivable is the gross amount minus the allowance for uncollectibles. So the gross amount was how much? Wasn't that 130? Return to question, sorry. Total accounts receivable was 130. All right. Now, let's see if they want you to say less. Less allowance for uncollectible accounts. That was 26,000, wasn't it? So what's 130 minus 26? 104. Check my work again. 104 is correct. Okay. So now let's see if we can move on. I guess it wants you to score the answer. Okay. Now we move on to the next question. The next question is a notes receivable question. And if I remember correctly, I don't think we really went through that in any amount of detail. So now would be a good time to learn that by looking at an actual example, right? So this is in your textbook again. This is on page 267, exercise 14. Exercise 14. Mr. Sandman. That was my terrible singing. Okay. All right. So let's look at this example here. Note, this is a notes receivable. So whenever you see a notes receivable problem, the complication is going to be interest, calculating interest expense, accruing interest expense, as the case may be. Okay. So April 1st, LeBron provides services to a customer on account. The customer signs a 4-month 9% note for $7,000. Now, you know, again, your training would tell you, oh, I should debit accounts receivable, right? But 9% note. So debit notes receivable. And credit service revenue. So, you know, this is what's called a trade receivable, right? Trade notes receivable, because it arose in the context of doing the normal kind of thing that we do for our customers, provide goods and services, right? Okay. Now, this is another way that notes receivable comes into being. On June 1st, LeBron lends cash. LeBron is acting like a bank. Lends cash to one of the company's vendors by accepting a 6-month 10% note for $11,000. We're going to debit notes receivable again. But this time we're going to credit cash. Right? And this is the third way you can get notes receivable. On November 1st, LeBron accepts payment for prior services by having, see now again, I don't like that word payment in there, right? Because when I see the word payment, I think of cash, but just follow through. On November 1st, LeBron accepts payment for prior services by having the customer with a past due account receivable sign a 3-month 8% note for $6,000. In other words, you had a customer that owed you money, and that customer came to you and said, hey, look, I can't pay you right now. Right? I need more time. And your response to the customer is, okay, I understand everybody goes through rough times, but I want this in writing now. Because accounts receivable is really just like a handshake, you know? I have something you want, and we just agree to do business. And it's pretty much, and we might have letters and things that go back and forth, but it's not really a formal contract, right? So now what we're saying is, well, the customer can't pay me. That's bad enough. But now if there's any other promises that are made, I want them in writing. Debit notes receivable. Credit accounts receivable. Right? So what are the 3 different ways you can have notes receivable? Well, one way is in the normal course of doing business, right? The normal course of doing business, the customer buys something for me, and instead of debiting accounts receivable, I debit notes receivable. Why would you do that? Because maybe the transaction is unusual. Maybe the customer wants to buy more stuff from you than they normally buy, so you want to give them more time to pay you. What's the second way you get notes receivable? You act like a bank. You lend cash. What's the third way? Well, someone that can't pay you, you want to give more time, right? Debit notes receivable, credit accounts receivable. All right, so we see that those are all correct. All right, so that takes care of that. Okay, so now we're back to this uncollectible accounts again. What's the journal entry? What's the adjusting entry for uncollectible accounts? Well, I know what that is. I just don't know what the numbers are. Right? I know I'm going to debit bad debt expense. I'm going to credit allowance for doubtful accounts. Now let's go back and read the problem. This is, Suzuki. Let's see, which one is Suzuki? Suzuki is exercise 19, right, which is on page 268. The following information applies to the questions displayed below. Suzuki provides the following amounts at the end of 2021 before adjustment. Now, again, a lot of times accounting problems, they tell you more than you need to know, or they tell you things that you don't need to know because they're trying to get you to go in the wrong direction. So look at what they tell you. Look at the first thing they tell you. Credit sales for 2021 are $260,000. I don't think that matters, right? We're looking to debit bad debts expense and credit allowance for doubtful accounts, and I don't think that that matters. Oh, wait. It might matter. It's not going to matter for this. Suzuki estimates 12% of receivables will not be collected. It won't matter for that. But we're going to see, all right, we're going to see that there's another part of the question where it may matter. Okay? So let's take a look at this. Record the adjusting entry for uncollectible accounts using the percentage of receivables method. Now, we're going to see when we get to the next part of the question, there is also something called a percentage of sales method. Right? There is also something called a percentage of sales method. So for that, we're going to need to know that 260. Right? But for now, we don't need to. So accounts receivable, 55,000. Allowance for uncollectible accounts, 1,100. Right? Now let's go back to that thing that we had here. Let's put these numbers in. Accounts receivable is 55,000. And the allowance for uncollectible accounts before adjustment is 1,100 credit. Now, again, just to review for a second, what does that mean? Why is there a balance in that account? Why is it significant? Remember that we're estimating here. We don't know exactly who's going to not pay. We're estimating. We're saying based on our experience, based on things that have happened to us in the past, we know that certain people don't pay. Right? We don't know who they are. We don't know when. We don't know anything like that. But we just know that that happens. All right? So we estimated last year. Remember, this side of the account, the credit side of this account represents the estimates, and the debit side of the account represents the actual. Remember, we saw that term write-off? When you write off an accounts receivable, you debit the allowance and you credit accounts receivable, right? Remember that from last week. So last year we estimated, and it doesn't even matter what that number was, right? We estimated, we put a number on the credit side of the account, and then during the next year, anytime somebody went bankrupt or told us they couldn't pay or we couldn't find them, they disappeared off the face of the earth, right? We wrote off that account by putting a debit in that account. Now, at the end of the year, if we look at this account, this tells you how much we were off in our estimate. If there's a credit balance in the account, it means that last year's estimate was too high by 1,100. If there's a debit balance in this account, like there was in the previous problem, it means that the actual write-offs were greater than the estimate. We estimated too little. But we're confident, right? And this is where maybe this gets confusing. We're confident over time our estimates are going to be correct. So it's our timing that could be off, right? It's our timing. So in this case, what we're saying is that there's $1,100 more of accounts that are going to go bad that didn't yet, but they will. Right? I don't know if that's helpful to realize that. Right? Now, under this method, we have to figure out, right? I'm going to put the word begin here, right? Begin. Right? Now I'm going to put the word end here. The ending balance in this account is going to be determined by multiplying this 55,000 times 12%. So what's 55,000 times 0.12? Okay. And my calculator disappeared from my desk. Anybody do a quick calculation on that? 55,000 times 12%? Anybody?
6,600.
6,600, thank you. Okay. So that's the number we want to appear here. So we want the ending balance to be 6,600. So how much does our adjustment have to be for? It has to be for a number that takes you from 1,100 to 6,600. That number is 5,500, right? That's the amount of the adjustment, 5,500. So if we go back, debit, credit, check my work. All right, we see that that was correct. All right, so that was the first part of that problem. And this, right, on December 31st, this is the entry that gets made. All right, now here's part two of the problem. Look what it says. Record the adjusting entry for uncollectible accounts. So I already know it's going to be a debit for that and a credit for that, right? I already know that. Now I got to work the numbers out. Record the adjusting entry for uncollectible accounts using the percentage of credit sales method. Percentage of credit sales. Suzuki estimates 3% of credit sales will not be collected. Now, under the percentage of receivables method, I need to go to my accounts and work this out. But under the percentage of sales method, it's much simpler. Under the percentage of sales method, all I have to do is multiply 260 times 3%. So what does that come out to? That's 2,600 times 3, right? Is that 7,800? 260,000 times 3%. I think that comes out to 7,300, 7,800. Okay. So actually, I like this method better because I don't have to worry about what's in the allowance account. I just multiply whatever credit sales are times whatever percentage they give me. And I don't have to worry about the allowance for doubtful accounts, making sure the balance comes out to be, you know, what I want it to be. This method is not as accepted as the first one because this method really, when you think about it for a second, this method is called the income statement approach because the number that you're calculating is the debit to bad debt expense. The other method, the percentage of receivables method, is called the balance sheet approach because you're really estimating what's in the allowance account. See the difference? It's kind of a subtle difference. The key for you is not to mix them up. Okay, now we're in the same problem. Calculate the effect on net income before taxes and total assets for each method. Suzuki estimates 12% of receivables and 3% of credit sales respectively will not be collected. All right, now let's see what they want us to do here. Under the percentage of receivables method, I don't know why they have all those boxes there. Under the percentage of receivables method, let's see, let's put the numbers in just to, okay. Increase, decrease. Percentage of receivables. Total assets are decreased by, what was the number in the account? Go back. 6,600, right? Let's see if that's what they wanted. Okay. And net income is decreased by, what was the debit to bad debt expense here? 5,500. Okay. Let's do a check my work just to see if we're on the right path. Okay, now this is right. Why is this? All right, well, let's come over here now. Under the percentage of credit sales method, total assets are I have to go back to the question. Total assets are going to be decreased by, net income is going to be decreased by 7,800. Okay. All right. And I would have said that total assets are decreased by, let's go back and look at this. Let's check this out. Okay. All right, so coming back to this, total assets are decreased by 5,500. Net income is decreased by 5,500, right? Why is that? Because assets were already decreased by 1,100. So overall, they were only decreased by 5,500, right? Now, under the other method, let's substitute some numbers here under the other method. The other method, we had this, which means we're going to have 1,100 and 7,800 is 8,900. Right? That's how we would wind up under the other method, under the percentage of, this is percentage of sales, right? So now let's go back and put the numbers in here. I'm going to say the same thing. Oh, return to question. Yeah, okay. So that was how you do that. Okay. Next. Right now, when you see this, they want you to do something called aging. And we went over that last time. Let me see if I can find it in the book. This was on page 241. And what this says is this. This is similar to the percentage of receivables here. But what we're doing here is we're analyzing the receivables in detail. right? In other words, we're saying that it's not enough just to say that 20% won't be collected. That we need to look in more detail. And to do that, we need to break the accounts receivable into categories based on how old the debt is. So notice how they broke it down here. Not yet due, 0 to 90 days past due, 91 to 180 days past due, 180, more than 180 days past due. And notice how the percent uncollectible goes up. By the time you get to more than 180 days, look, it's 80%. 180 days is 6 months. If someone hasn't paid you in 6 months, I guess it's safe to assume you won't get paid, right? So let's go back now and read the problem. Now, again, the total accounts receivable is $80,000. But we're going to take each of these age categories and multiply it by these percents and then get those numbers and total them up. And that number represents what we want to see in the allowance for uncollectible accounts. So let's read what this says. Pearl White, the dentist, during 2021, Pearl provides services on account $590,000. Of this amount, $80,000 remains receivable at the end of the year. That's here, it's the $80,000. So again, why they told us the sales number, we probably don't need that, but just, just note it. An aging schedule as of December 31st is provided below. Calculate the allowance for uncollectible accounts, okay? So let's do it. Let's just put some numbers here just so, we get a feel for what's going on. This is 80,000. Okay. This is in your book. This is problem 8-4A, which is on page 271. Okay. So we don't know what this number is, right? And I think what they do is they give us different scenarios with the beginning number. So let's do this. We've got age group. We've got amount. We've got percent uncollectible. All right, and we've got amount uncollectible. Okay, so the age groups are not yet due, right? And this comes right from your book, right from the problem. And the percent uncollectible is 4%. 0 to 90 days past due, right? And that's $16,000. Can you all see what I'm doing? This is on an Excel worksheet. You can see this, I hope, right? Yes?
Yes, sir.
Good. Okay. So we got 0 to 90 days past due, and that was 20%. And then we've got 91 to 180 days past due. And that was 11,000 times 25%. And we've got more than 180 days past due, right? And that was 13,000. And that was 80%. Okay, so now if I multiply 40,000 times 4%, I think that's 1,600. 16,000 times 20%, I think that's 3,200, right? Uh, 11,000 times 25%, is that 2,750? Someone check my math. And 13,000 times 80%, is that 10,400? Right? Can someone check my math, make sure I got those right?
Yeah, they look good.
Okay, so the total, this I know is 80,000, right? And what's the total of all of these? Let's see. $17,950. All right. This 17,950. Well, this represents total accounts receivable, right? This is total AR, right? And this represents ending balance in allowance account, right? This is the ending balance in the allowance account. So now let's go back here, and I want this number to be 17,950. So I already know accounts receivable is 80,000. And after just doing this analysis, I calculated that I want this ending balance to be 17,950. And what does that represent? That represents the portion of this 80,000 that I don't think I'm going to collect. Okay, so let's now go back to this. Okay, this was what, 1,600? This was 3,200. This was 2,750. This is 10,400. And let's do check my work. Okay, so we know that we're right to that point. Okay. Now, what's the next part of the problem? Record the entry on December 31st, assuming the balance of allowance for uncollectible accounts before adjustment is 5,000 credit. In other words, what they're saying is if you go back here and look at this, the beginning amount is 5,000 credit. So that means my adjustment has to be for a number that takes me from 5,000 credit to 17,950 credit. So what number do I need to add to 5,000 to come up to 17,950? Is that 12,950? Right? 12,950 plus 5,000 is 17,950, right? That should be the number. I write it in here before I forget. 17,950. Oh, no, 12,950. Debit bad debt expense, credit allowance, right? 12,950. Check. Right? Correct. Okay. All right. On July 19th, 2022, a customer's account balance of $8,000 is written off as uncollectible. Record the write-off. Now remember the trick, I shouldn't say trick, but the trap. A lot of times, as soon as the student hears the word write-off, they say bad debt expense. But remember, bad debt expense is only December 31st. So it can't be bad debt expense. It's allowance. And remember what we said about this account. The credit side of the allowance account represents estimates of what we don't think we're going to get. But the debit side of this account represents actual customers, actual people that we gave up on. That's what the term write-off means. It means you gave up on the account. It doesn't mean bad debt expense. It means you gave up on the account. Remove the account. Remove him or her as if they never existed in your life. Remove them. So how can you remove them? Debit allowance and credit accounts receivable. Okay, so that's right. Okay. Now, only in the world of fairy tales and accounting textbooks does this happen. The account that you wrote off, all of a sudden out of nowhere pays. Well, I guess if they paid, you shouldn't have written them off. If they paid, you should not have written them off. So what we do is we need to do two things. The first thing we need to do is to put it back. They use the word reestablish. Reestablish the account previously written off. In other words, do the opposite of what the write-off was. Debit accounts receivable, credit allowance. Right, that's the first part. And the second part is the part you like. Debit cash and credit accounts receivable. Right, so those two entries are correct. Right, and the nice thing about this problem too is that it walks you through the whole cycle, estimating the account, estimating the balance of the allowance, making the entry, writing off an account, and reestablishing the account. Okay. So now that's chapter 5. That's the homework from chapter 5. Maybe we should look at another one since we have time. I mean, we could look at one just like the one we just did here. Exercise 5-4B. You know, there are B problems, right? In addition to the A problems. This is on page 274 in the book. We'll have to do it over here. Right, this is problem 5-4B, right? And this is on page 274. All right, so let's take a look at that one, what that says. Facial cosmetics provides plastic surgery primarily to hide the appearance of unwanted scars. They got to give you that detail, you know. During 2021, the company provides services of $410,000 on account. Of this amount, $60,000 remains uncollectible at the end of the year. So here, instead of 80, it's 60. Right, now they give us this kind of information. An aging schedule as of December 31st is provided below. Calculate the allowance for uncollectible accounts. In other words, we have to calculate this number here. Same way we did there. So not yet due is 40,000 and the percentage is 3%. Zero to 30 days past due. 0 to 30 days, not 90. Is 11,000. And the percentage is 4%. 31 to 60 days past due is 8,000. And the percentage is 11. And more than 60 days right, is 1,000. And this is 25%. So the total accounts receivable, if I add it up, right, 60,000. And here we'll have to multiply these numbers out and then add them up, okay? Why don't you see if you can do that? Okay, so if you do the arithmetic here, multiply the numbers in this column times the percentages in this column, you'll get these numbers. And then when you add them together, you get 2770. And that 2770 is this number. It's the ending balance in the allowance for uncollectible accounts. Right, now, we have some questions to answer. Record the December 31st, 2021 adjustment, assuming the balance of the allowance before adjustment is 400 debit. So the beginning amount is 400 debit. Okay. Now what entry are we going to make? December 31st, we're going to debit bad debt expense and credit allowance for uncollectible. Allowance for uncollectible accounts, right? Right, calculate that number. Okay. So here, what does the number have to be? To go from a debit of 400 to a credit of 2,700, right? I mean, add 400 plus 2,700 is 3,100. And if you analyze it, 3,100 minus 400 is 2,700, right? So again, what could be a simple rule? If the balance in the allowance has a beginning balance that's a debit, add it to the ending balance. And that's the amount of your adjustment. If the beginning balance of the allowance is credit, subtract that from the ending balance to get your adjustment. So debit you add, credit you subtract, right? Kind of a cheater's way, but whatever works, right? 3,100, 3,100. Okay. Okay, now, next, number 3. On April 3rd, a customer's account balance of 500 is written off as uncollectible. Record the write-off. All right, go ahead, try it. It's not bad debt expense. What account do you debit to write off? All right, you debit the allowance for uncollectible accounts. Credit accounts receivable. Okay. Now, when you do that, when you debit that allowance for uncollectible accounts, this is what you're saying, right? You're looking at this and you're saying, yeah, that 500, that number was included in here. I knew that number was in here. I just didn't know who it was. Remember, this is the estimate and this is the actual. They didn't ask for that, so I'll take it out, right? But that's really what you're doing. You're saying, yes, I knew that I had to put 3,100 here, and included in that 3,100 was this 500. That's why I debit that account. I credit accounts receivable because he doesn't exist or she doesn't exist in my world anymore, right? That person is out of my life. To get somebody out of your life, you credit accounts receivable. I wish it was that easy in real life, you know? Now, what happens next? Again, it's kind of a fairy tale because in real life, people don't usually do things like this. But April 17th, which April 17th is like what, 3 or 4 months later? The customer whose account was written off unexpectedly pays, not all of it, $100 and does not expect to pay any additional amounts. Record the cash collection. Now, that's a little deceiving because before the cash collection, you have to reestablish the account, right? You have to reestablish the account. So how do we do that? This is on July 17th. Well, to reestablish the account, you have to kind of do the opposite of what you did here. But only for the amount that they pay. So in the last example we did, right, the customer paid the whole amount. But here the customer is only able to pay you $100. So you only reestablish for $100. Right? And then you make this other entry. Right? I don't have room here, but I'll put it down here, where you debit cash and credit accounts receivable. Right? So that's really everything that you need to know about accounts receivable. at least this part of it, the estimating the bad debt. And again, this is because we're on this accrual basis of accounting that we have to estimate the bad debts. Are there any questions? No questions?
No, sir.
Okay, so let's talk about some other things. The semester is half over, right? I mean, at least in terms of the work that we've done, a little more now, right? But you've had 2 exams so far. So I guess you can kind of gauge yourself how you're doing. Most of you are doing very well. Most of you are doing very well. Keep up the good work. But some of you are not, and the reason you are not is because you're just not doing your work. Remember, every assignment has points attached to it. If you don't do those things, you don't get any points. So I'm not trying to sound mean or anything, but if you don't do any work, how do you expect to pass? I mean, it's simple as that. So, I mean, there's still half a course to go, but remember, if you didn't take the first 2 tests, right? I mean, just use a little logic. If you didn't take the first 2 tests for whatever reason, and I don't know if that applies to anybody, I'm just saying hypothetical case. If you didn't take the first 2 tests and you got 100 on the last 2 tests, I mean, that only averages to 50, right? And 50 is not passing. So, please, if there's anything I can do, please get in touch with me. I mean, I'll try to be reasonable, but I don't really know what I can do. If you're not doing anything, I don't know what you expect me to do. All right, so that's one thing. I know it's unpleasant to talk about, but we really should get it out of the way. Other things, registration for the spring starts on November 16th. So watch your email. If you haven't already gotten something, you should get something very soon. Registration starts November 16th. And again, I think the people that register first are the ones that have been here the longest and all of that. So keep your eye out for that. What else? I think, I'm not 100% sure, but from what I've heard, we will be remote again in the spring. So I don't know how that affects you. If you like it, don't like it, whatever. We will be remote again in the spring from everything that I've heard so far. Maybe I'm wrong, but that's what I hear. So, plan around that. What else? Does anybody have any question about anything?
No, sir.
Okay. Let's take a look. Let's see if there's something else we can do. Let's look at a notes receivable type of problem. This is exercise 5-17, and this is on page 267. Okay, because we talked about notes receivable, we really didn't work with any numbers or anything, calculating interest, etc. So let's take a look. This is exercise 17, page 267. Now they give you kind of a scenario here of how the note came into existence, right? So let's just walk through it. On April 1st, 2021, Shoemaker Corporation realizes that one of its main suppliers is having difficulty meeting delivery schedules, which is hurting Shoemaker's business. All right, think about this for a second. This is a real life situation. Think about it. You have a business, you're doing great, but you have to buy stuff from other people that you need to use in your business. One of those people that you depend on is having financial problems, which means that if that person goes out of business, you will not be able to get the thing that you need. So let's take a situation, it's a little exaggerated, but think about it for a second. Everybody loves Apple phones. There's a tremendous demand for Apple phones, whether you like Apple or not. Their products are extremely popular. And let's say you have a store where you sell cell phones, right? And Apple comes to you and says, we're experiencing financial difficulty. Can you loan us some money? Right? I mean, far-fetched. Is Apple going to ask you for money? I certainly hope not, right? But think about it, they have a very popular product. You want to put that product in your store. It's almost sure to sell out as soon as you put it up on the shelves, right? But if that company goes out of business, you won't have that product to sell, and that will in turn hurt your business. So if something like that happens to you and somebody asks you for money, right, even though you probably don't really want to, you may be forced to. Let's take another example that maybe isn't as far-fetched. Let's say you're a company like Boeing that makes jets, right, aircraft. And look at all the different parts that are in an airplane, right? Probably millions of parts. Think about it. From big parts like the engines to little tiny parts like screws that hold things together inside the plane. And one of those companies that maybe they make a certain type of screw that you really can't get from anybody else. It's like a weird type of screw, or some type of electrical wires that nobody else makes but this one company. And this company that you need to maybe put a $10 part in your billion-dollar aircraft, if you don't have that $10 part, you can't finish producing your billion-dollar aircraft. So if that supplier comes to you with a problem and wants a loan, you may have no choice but to do it. Because if that company goes out of business and you can't get that part anywhere else, your billion-dollar airplane is going to sit there in the factory and can't move. So that's the kind of scenario they're talking about here. Who wants to lend money to somebody having financial problems, right? Just bad business, no common sense. Shoemaker agrees to lend $600,000 to its supplier using a 12-month 11% note. So what entry is going to get made on April 1st? Debit notes receivable, $600,000, right? Now, a supplier, somebody that you buy things from, it's somebody that you probably owe money to normally, right? You would debit inventory and credit accounts payable when you buy stuff from them. So just not to confuse the issue, this isn't an accounts receivable. So, and when I see the words lack of funds, that tells me that they want me to give cash. So debit notes receivable and credit cash, 600,000, right? And this is a, what is it? 12-month, 11%. 12-month, 11%, right? And I'm just writing that down there to remind myself that I can expect to receive that money April 1st of next year, right? So this is April 1st of 2021, and I can expect to receive that on April 1st of 2022. 600,000 plus interest. So that's number one. That's the first thing they wanted you to do. Number two, what adjustment do I make for accrued interest at December 31st? December 31st. Okay, now remember, you're the lender, not the borrower. If you were the borrower, you would debit interest expense and credit interest payable. But since you're the lender, you're going to debit interest receivable and credit interest revenue. All right, now let's calculate the amount. 600,000 times 11% times how many months? How many months is it from April 1st to December 31st? It is 9 months, right? 9 months out of 12. So 600,000 times 11% is $66,000, but that represents a year's worth of interest. Whenever you see a percentage in a problem like this, that's an annual rate. If it's for a shorter period of time, you need to multiply by that shorter period of time. This is 9 months out of 12. So 9/12 times 9 divided by 12, or you could say 9/12 is 75%, 0.75. 66,000 times 0.75 is $49,500. $49,500. In other words, how much interest did you earn on that $600,000 from April 1st through December 31st? This was an example of accrued revenue. You remember when we talked about adjusting entries in chapter 3? Accruals. This is an example of accrued revenue. Accrued expense would be interest expense and interest payable, right? But accrued revenue, debit interest receivable, credit interest revenue. Now the third entry, cash collection of the note and interest on April 1st, 2022. So 2022, April 1st, we're going to get paid. So you know you're going to debit cash. You just don't know the amount yet. The amount is going to be what? It's going to be the 600,000 plus a full year's interest, a full 12 months interest. Now, a full 12 months interest is 600,000 times 11%, which is $66,000. So you're going to collect, how much are you going to actually collect? 600 plus 66 is $666,000. Did you just get a chill when you saw that? Right, 600. The number 666 is the mark of the devil. Ugh, that just freaked me out. Okay, now I know I'm also going to have to credit notes receivable for 600,000. Now, ordinarily, I would get all excited and say, okay, I'm going to credit interest revenue for 66, but I can't do that because why? Because I already credited interest revenue for 49,500. So what account am I going to credit for 49,500 is this one, interest receivable. And when you think about it, why does that make sense to do? Because included in the $66,000 of interest is the interest from last year that I was owed. So I'm going to credit interest revenue now. Right? I can take the coward's way out and I could say, okay, what number do I need to balance the entry, right? 666 minus 600 minus 49,500. I can do that. Or I could calculate that number, right? How would I calculate that number? 600,000. Let me put it underneath. 600,000 times 11% times how many months? Remember, it was a 12-month note. 9 months in 2021, 3 months in 2022. 3 over 12. 3 over 12 is 1/4. That comes out to $16,500. Right, so debit cash for the 600 plus the full year's interest, which is 66,666. Credit notes receivable for the principal amount, which was 600. Credit interest receivable for the amount that was accrued at the end of the prior year, and credit interest revenue just for the time this year, right? This time is 3 months. Last year was 9 months. It's a 12-month note, right? So that means 9 months last year, 3 months this year. Okay. All right. So let's take a look. Let's take a look at where we are with something here. Should have done this first. Homework. Chapter 5 homework. Okay, you still got time, right? It's due November 6th, which is next Friday, I guess. November 6th. And then we've got 2 weeks on chapter 6. Chapter 6 is another long, pretty long chapter, if I remember correctly. So November 6th, got plenty of time. We finished it all, so it shouldn't be an issue. What else? Now, exam 3 is on chapters 5 and 6. Notice the date is November 25th. If I remember correctly, that's the day before Thanksgiving, right? That'll be I think it's the Wednesday before Thanksgiving, right? So class, plan, right? Plan accordingly. I know the holiday times, things start to get crazy. They get hectic. Maybe you have to travel or whatever, right? So just build it into your schedule. November 25th is going to be exam 3, which is chapters 5 and 6. We're already done with 5. November 26th, that's almost a month away, isn't it? So time shouldn't be an issue for you, right? You got plenty of time to work these things out. Right? Does anybody have any questions for me? No questions?
No, sir.
Okay. Okay, so get to work, right? And I will see you next week. We'll start chapter 6.
All right. Have a nice day.
Okay. Be well, everyone.
Good weekend.